Okay, so today's lesson is looking at the role of financial regulation or intervention in financial markets to increase the stability of those markets. In the UK specifically, the Bank of England has a major role, but there is also an independent financial regulator as well, and also just looking at how the wider financial system can become more stable because of this. So just a reminder that we're kind of looking within, after looking at financial market rules and financial market failures, we're now looking at how we can try and prevent or solve some of those failures through the Bank of England. Initially, and we've covered this in terms of the negatives, that it creates a moral hazard, but central banks are seen as lenders of last resort, and there's just a few examples of the different central banks around the world. The most significant ones: the US Federal Reserve, Bank of England, European Central Bank, a couple of other large ones, Bank of Australia, Central Bank of Japan and Canada, and significantly, and becoming more so, the People's Bank of China. So what the lender of last resort is mainly for commercial banks, investment banks, retail banks, if they are unable to raise funds themselves from money markets, from capital markets, they can go to the central bank and they will loan for a short period of time a level of funds to allow them to continue to operate. One clear thing is that this is not a bailout. So when the government bailed out Royal Bank of Scotland, they effectively used fiscal policy to nationalise those banks. A lender of last resort is from the central bank, and it's a loan of funds. So this is to keep banks in private ownership. So for example, if HSBC went to the Bank of England to loan funds, they would still be HSBC. At the end of it, they'd still be in control of their own business. Effectively, Royal Bank of Scotland was nationalised because the government owned a significant amount of that business. So that's the difference between a bailout and the lender of last resort. The purpose of the lender of last resort is to stop that systemic risk, or the risk of a cascade, a domino effect throughout the financial system, so that one bank such as Barclays failing would impact on HSBC, which would impact on other banks. So this is seen as an intervention to create stability. So the lender of last resort creates stability within the financial system through banks knowing that if they do enter a difficult period, that the central bank will give them funds to keep them going. The next little section from the reading is around the role of the banker to the government. So to a larger or lesser extent, depending on the country, the central bank is the government's bank. The government doesn't bank with Barclays, it doesn't bank with HSBC. The central bank is the government's bank. So the fiscal policy part of the country is coordinated through the Bank of England. So if taxes are raised, they are stored with the Bank of England, so it maintains the accounts. It then also maintains the ability to pay funds from that. It issues the currency, it manages the supply of currency within the economy, and it also advises the government and represents the government internationally through monetary meetings and monetary policy globally. In certain circumstances also manages the national debt or deficits of a country in terms of issuing and buying and maintaining government bonds. So in itself, the success of a central bank can also be the stability of government finances. One significant change in the Bank of England, or one thing we haven't really covered, is that there is a financial policy committee. So we've looked so far at the monetary policy committee, how their 9 members decide interest rates, quantitative easing for the UK to manage aggregate demand and achieve an inflation target. There is also part of the Bank of England which is the financial policy committee, and they are tasked with trying to keep the financial system stable within the UK. This is just an example of one of the previous reports from 2018, and the things they were looking at was bank resilience. So can banks withstand shocks to the system? Looking at the impacts of Brexit at that time, significant rises in global debt, and on that little globe it's trying to represent China as a significant risk to the global financial system. And also significantly leveraged lending, which means lending to a large extent above what your assets should let you do. And if you remember when Alex Fraser came in, he was one of the members of the Financial Policy Committee. So part of his job was, and when he specifically talked about it, it was about seeing if the banks could withstand different versions of a Brexit. The role of the Financial Policy Committee is looking at financial stability, like I just said, and looking at the supply of credit within the banking system. So this is whether or not the types of lending that is going on are high or low risk, whether or not there is enough credit and financial capital within the system. So will building societies be able to lend to homeowners to buy houses? Will banks be able to lend to businesses to continue the economy? And this is one of the specific things that they can do, is regulate quantities and prices within the financial system. So a loan to value ratio that it says there is that the person who comes in to ask for a mortgage needs to have a certain level of earnings or assets to cover that mortgage. So a loan to value ratio. They can also, and they have, regulated the amount of reserves that banks would need to hold. So a percentage of more low risk assets in relation to the lending they're having, so holding on to cash or other government bonds rather than using save as funds to speculate on futures markets. So that those two things are about regulating to reduce the risks of a further financial crisis. So making sure that loans are to less risky individuals, and making sure banks have enough assets to cover the cash deposits of savers. So looking at kind of the Bank of England, apart from monetary policy, so regulating banks, issuing banknotes, maintaining stability, and we've just looked at the Financial Policy Committee. There are 2 other financial regulation bodies that are linked to this. From 2001 to 2013, the Financial Services Authority, the FSA, were involved in regulating the financial system. From 2013, that was split off into 2 parts, a part which stayed within the Bank of England, which was the Prudential Regulation Authority, and the Financial Conduct Authority, which is a separate non-government organisation. What the PRA does is it regulates and supervises financial institutions, so banks, building societies, credit unions, insurers and major investment firms, and they really look at the big players within those markets, and that's where they can regulate prices, regulate risk and so on. The Financial Conduct Authority looks more at whether or not there are other market failures happening, so market dominance. They may intervene, they may prosecute or investigate where there's market rigging, where there are information failures. They will investigate and they can fine or punish the firms that do that. So separating out general and specific regulation within those markets. This little table is in your notebooks, but it's also from the Bank of England, and it looks at the asset composition. So looking at that, regulating the amount of assets that banks have to hold. The Bank of England and the Prudential Regulation Authority and the Financial Policy Committee have looked over time, and what you have is the darker is the lower risk, so on this side low risk, and the pink and dark pink are the high risk assets. And you can see that in the financial crisis there was a significant amount of high risk assets in banks, and this is one of the reasons why the financial crisis was so severe afterwards. In 2011, after the start of intervention, you can see that there is an increase in the amount of lower risk assets due to increased scrutiny and regulation of banks. Okay, so if you read the page 41, 42 in the book around central bank role, make some notes on the financial stability of the UK, try and create a diagram of what you think the structure is. So visualise what that is, describe what the lender of last resort and bank that the government involves, and submit.